What is going on, traders? This is going to be a topic about profitability. What? Profitability? Don't I just need edge to be profitable? You might ask. Come on, if you have edge, what else do you need? Well, this topic is very near and dear to my heart, and this applies to all of you guys who are in the room as much as anybody else, because when you have a pretty big toolkit, you are often convinced to avoid your risk management. You're convinced that you can size up a little bit, that your next trade will be better than your last one, and all of that tilt becomes a death spiral. So, what this video is going to show you guys is that you can have all the edge in the world, but if you do not understand risk management, it does not matter if you're the world's best trader and you give it all back. And I'm going to show you guys exactly how that can matter. Okay, so what we have here is a very simple chart, right? This shows the RTH, or regular trading hours open. This little darker shaded area is Globex. And what I want to show you guys is, let's say, we're going to make some assumptions here. We're going to say that you have a $10,000 account, okay? And you are, let's say, risking 1% of that account per trade, which would be 10,000 times 0.01 gets you, and it gets you $100 of risk per trade. Okay, and you're trading micros, so we're trading Nasdaq here, and you're trading MNQ. And so let's just say you have a thesis, and your thesis is that you want to be short from this area here. Okay, and your thesis is that you want to be short and you want to win, let's say, back to what you consider this support area. And so if you're taking a trade here, and we're going to use a little automatic R factor tool, and you're entering, say, right here, and you're looking to enter a trade here and trade this all the way back to here. If the market comes up into this area and it fills you, how in the heck, let's say if you want to take profit here, how in the heck are you going to calculate what is greater than 1% risk per trade? Well, the way you're going to do that is you're going to say, if my position is short here, my entry is here, and my stop is up here, then on MNQ, which is $2 per point, then you can quickly come in here. You know what? First things first. Let's go rewind the market and put replay on and just replay this market at this point. Okay, so what is this time? This is right off the open here. It's 6:30, and it's today's date. So we're going to say 6:06:30, and then we're going to go play it at 1x speed, and we're going to hit play. And yeah, sure, go ahead and clear all the data. Okay, so you're over here. You've got this trade set up, and I guess we'll turn on this DOM here, and you're like, well, I want to be short here, right? So let's change the order types. Let's just say it's like this, okay? And your stop's going to be up here and here. Okay, so into your chart. First off, one thing you can do is, see how this is 9 points? You can change that to a dollar value, okay? And you can change your quantity. You can say 6, and then, all right, so if you are using points like we are here, then 5 points times this amount, or at 6 contracts short, with the stop up here, you're looking at 55 points times $2 is about $100. Okay, so 6 is too much. So then you're talking about 5. Okay, so if you're shorting here, right, and you're looking to take profit down in this area here, so you're looking to get 96 points for 5 MNQs, right, or almost $200, but you're looking to lose $100 on this trade, which would be 1%, as we've already figured out. That'd be 1% of a $10,000 account. So maybe that's acceptable risk based on your trading edge and what you have run through the Monte Carlo simulation. So you're like, what the heck is a Monte Carlo simulation? We'll get to that. But if this is your setup and you're risking on this, you're risking $100, and let's just say we go ahead and start the market, we let it play, we let it go. Okay, so here it goes. Market's ripping, still going, still going, still going. All right, you're gonna get your fill here pretty soon. All right, there's your fill. All right, so let's pause this. Okay, so you're in a position, right? You're in a position and you're short, looking to take profit here. So you keep going. And initially you have a stop here, right? You're like, okay, this is my stop. If it nails it, I'm out. But then it gets close and you move it up. And you say, you know what? I don't want to lose on this trade. Okay, so let's pause it again. And now you're underwater 50 points. And you say, well, I'm going to average in this position, this, and I still want this as a target, but now I'm going to average in. Okay, so you go in and you get short again up here, right? And you're like, well, I don't want this thing to get stopped out. So now you're double your size, okay? And if this thing, let's say you move your stop even a little more, and now instead of your R factor on that trade being 2, your stop is closer to, as you doubled size, your stop is closer to 1.2 Rs. You say, well, what do you mean 1.2 Rs? Okay, so let's move our stop tool up like this, okay? All right, now you're moving your stop way up here. So you got to take this point, and it's going to be in between here, right? So there you go. Now you've reduced your R factor significantly by averaging in. When you do stop out, you're doing 65 plus 92, which is what, 150 points roughly? So it screws up all your stats. It screws up your Monte Carlo big time. And so let's just let this play out. Let's see what happens to the trader who constantly moves their stops thinking that they are just going to average in and get bigger and bigger and bigger. Okay, so let's run this through. Okay, so it's going up, goes up, goes up. And you're like, crap, it keeps going up. Let me move my stop again. You know, as a matter of fact, I'm gonna add to this position, move my stop way up here, and I still want to get out here, right? Now, let's pause it. If what happens right now, since your average is here, so let's adjust our little R factor tool. Okay, now your stops are now up here. Whoop, average stops. Okay, here's your 1R now, right? Here's your 1R. Now, what's your risk on this trade? Now that you've gotten so much bigger on this trade, what's your risk? 127, 117, and 133. So we know this is roughly 260. This is 380 points times what? Times 2. So 380 points times 2 plus commissions, you're talking about $760. Now on a $10,000 account, you're now risking 7.6%. Think about this in terms of when you put it into Monte Carlo, what a 7.6% risk on account looks like when we go look at this later, okay? So this is the fallacy of I can average in and actually get away with becoming a profitable trader, okay? So your average is here. You're still looking for this. But what do traders often do when they get too big? Their mind turns to mush, number one. Why does their mind turn to mush? Because the brain knows you can't trick it. The brain knows that, hey, buddy boy, you are risking way too much of your account. And if this goes sour, you're going to give back days or weeks of trading. You start tilting, your perception of the market gets skewed, and you do irrational things. But what we're trying to do is we are trying to bring rationality and logic to what it means to ignore size, ignore your trading rules, average into losers, and not take your stop. Okay? And then we're going to look at it in Monte Carlo and demonstrate why the heck this is such a bad idea. Okay? So let's continue with this scenario, right? You're now risking 7%, over 7% on your account based on getting too big. Okay, so we're going to go ahead and play it. We'll speed it up, speed it up, speed it up. So, oh man, I could have been in profit here. Maybe I should have taken it. Your brain starts thinking quite irrationally. You say, oh, a little bit of weakness. Yeah, it's not really working out. You know what? I'm going to go ahead and short it again here and put a stop up here. And I'm going to come all the way back here. All right, pause it again. All right, now you're making a rational decision. You say like, well, it's stalling out here. It's stalling out. Meanwhile, what have you done? Right, your position's over here. But look, if you have a 17 lot position, so let's just go change this to 17, right? We're going to go change this. And we'll delete this, this, and this, okay? And we move this up here with your stop. 484 points. Why don't we just move it up? Let's make it an easy almost 500. Now you're risking 10% of your account just because you're ignoring size rules. Nice wide stop. Now, here's the uncertainty about the market. Where should you be invalidated? Maybe just outside of this range? Instead, maybe you have a nice wide stop up here because you're thinking irrationally because you've gone too large on your position. Rather than just what? What could you have done here? You could have said, I am in a short here and I stop out up here and I lose my $100. Instead now, you're risking $1,000 by ignoring your trading rules. Okay? And in doing so, your risk of ruin goes through the roof. Okay? So what ends up happening in a situation like this? All right, let's keep playing. Let's keep playing. 6x speed. All right. So market comes in, 10x speed here, comes in, comes in, comes in, comes in. Look, on a position that is this big, you know what your brain does at about here? And remember, that was 6x speed. Your brain goes, man, if I would have taken this and this and this right here, I could have had like $400 or $500. The problem is, oh dummy, you have no idea if the market's going to do this and take your whole stop. And so having a nice fat stop loss on a huge position risking 10% of your count is about the dumbest thing you can do as a retail trader and as a professional trader. So you should absolutely never do this. And we're going to demonstrate why you should never do this in Monte Carlo. But what I said earlier about starting to tilt because your size is getting way, 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 way too big, it starts to play tricks with your mind and you end up doing dumber and dumber and dumber things. Why? Because you are risking way too much. You can't trick your brain. Your brain knows your risk of ruin is too high. And I'm going to show you why your brain knows here in a second. Incidentally, we are also bad at statistics, but the brain is very good at making you nervous when it perceives way too much risk. Okay, so we're going to take these. We're going to move these back all the way down here, right? We'll just keep them over here. Okay, same thesis, and we're going to go ahead and play this again. All right. So now, maybe at this point, every time it goes into profit, these are 1 minute bars, you're getting really, really nervous. Your stop is still way up here. Let's pause it. You've now gone into big profit. More profit than you would have gotten if a 4 lot from here worked out all the way back down to this, or a 5 lot from here worked out all the way back down to this area, and you made 200 bucks, okay? Because you're oversized. So your brain starts thinking irrationally about this position. No longer do you want to wait to take profit. You want to start scaling out, but your stop is still way up here. So what? You're going to scale out, right? Scale out, reposition over here. And then what? Move this stop even higher. You guys, the market can go whoosh and take your whole stop at any time. A stop loss for a trader is kind of like somebody who skydives. If you skydive without a parachute, you're as good as dead. As a trader, if you move your stop loss, it's like a skydiver who jumped out of a plane. He's rushing towards the ground. He goes, "Oh, I love falling out of the sky so much. It's just so fun. I'm going to wait just a few more seconds to pull the ripcord." Right? Alarms going off. Your wristwatch is beeping at you saying, pull it, pull the ripcord, and you're like, you know what? I'm just going to wait. I'm going to average in. Essentially, you're averaging into this position. You're getting bigger and bigger and bigger, putting on more and more risk. Now, the guy with no stop loss is the guy that doesn't even have a ripcord. He has no parachute. He's dead. That's just stupidity. The guy who moves his stop loss like this is a guy who's rushing towards the ground. He's already calculated where he needs to pull the ripcord. The timer's going off, and it's for his benefit. It's to keep him safe so he doesn't break his legs or die. So as you rush closer and closer to the ground, you decide to delay in pulling your ripcord, which in this case is you're moving your stop up, you're getting a bigger position. You are increasing the probability of trader death over a series of trades. And you should rewind that and really drill that into your head. You are increasing the probability of your trader death over any given number of trades. And we're going to put that in Monte Carlo and demonstrate it. Because big position sizing, when you look at Monte Carlo simulation, is absolute death. Absolute death. It doesn't matter that you have a winning strategy if you lose everything on 1 or 2 trades or 3 trades or 4 trades. Okay? And that's what moving your stop does, guys. Moving your stop is ultimately trader death. Don't do it. Take the loss. Keep your mind clear. Take the next trade. Okay? So, let's look at this in Monte Carlo now, right? That we've demonstrated some of these ideas. All right. All right. So the first thing we're going to do here is we're going to look at this Monte Carlo, and we're going to say we have a $10,000 account. We're risking 1% per trade. We're looking for 2 R's on each trade. We're going to assume that we have a 40% win rate. We're only going to win 4 out of 10 trades. And then we're going to ask the question, does that, if I stick to my rules, in other words, if I only win 4 out of 10 trades and I stick to my rules here, and that's a winning system, okay, can I be profitable? And the answer is that most people in this situation are profitable. They are returning roughly, so you know, this is roughly 15% on account over 100 trades. That's actually still a decent system, right? So in other words, if you win 4 out of 10 trades and your winners are 2x as big as your losers, and you follow your rules, and here's the kicker, you risk 1%, everything works out. However, what if you do the same thing, but you say, I'm the guy that did what I demonstrated. I size up and I move my stop. Okay? Size up, move my stop, and you change the rules of the game on your trading as you go along. Okay? So we're going to change something here. We're going to say that instead of risking 1%, let's just look at this. We're gonna say we're gonna risk, I don't know, 10%. Was that part of what we did? Okay, we're gonna say 0.10, so 10%. And now we're gonna look at this graph go absolutely bananas, right? 10%, the risk of ruin is actually, look, your average somewhere in here, but there's extreme drawdown. It doesn't even show you some of the crazy drawdowns that occur. At 10% after trade 16, in one scenario, this is a randomized scenario, look, you're down already 14, 15%. How is that going to tilt you? You have to ask yourself this question. How is that going to tilt you? Everybody likes to look at this end result, but how is losing a whole bunch going to tilt you? All right, so 10%, ridiculous. What if we go 5%? What does this graph look like, right? Because this graph it's got some outliers that makes this totally out of control. Even at 5%, here, let me show you something. At 3%, the vast majority of traders are somewhere in here, okay? But there's a whole lot of people who break even, and their risk of ruin goes sky high, meaning it's possible that on a $10,000 account, because some of these lines go down here, right? You can't see them, but they do. You're talking about having your account or reducing it by 50%. You say, I don't care. I think I'm going to be this guy. Look, this is 200 different traders. This represents 200 different traders here. And each line is one trader doing 100 trades. That's what that is. So, number one, when you increase your size, your tilt is going to go through the roof when you actually lose. How many times are you going to lose in a row? You're going to have, on a 40% win rate, you're going to have over 100 trades. You're going to have 9 losers in a row. What is that going to do to you if you're risking 3% of your account every single time? Not to mention, are you sizing down each time you lose so that it's still 3%, or are you just doing the same lot quantity? If you're just still doing the same lot quantity, then guess what? You're going to be losing more than 27% of your account. It's going to be more like 30, 35% of your account. And how tilted are you going to be? So your decision making will be compromised. However, if you simply just risk 0.5% of your account, sure, you make less. But you know what? The 9 losers in a row, oops, yeah, it keeps putting this in here. Got to click off here. The 9 losers in a row, you make less, but your risk of ruin is not as great. You see that? You're still talking about 9K here. So even if you're one of the unlucky people in Monte Carlo, you are not blowing up your account. Even with 40% win rate at 2R R factor. Now, you guys know we get much better than that in the group. And so the problem is that when you have so much edge, you typically want to overtrade. You want to trade more and try to make it up when you have a losing day. If you are tilted, and this is the key, if you are tilted and you start thinking about abandoning rules, you need to sit on the sidelines until you can come back and say, you know what, I can still play with a defined stop and I can accept losing. Otherwise, you're going to be one of these guys that does something as silly as this, where you go over here, you start risking 3%, your win rate is 50%, and your R factors are 0.93, so less than 1, and you are ultimately just a losing trader. Yeah, some of them get lucky. They win a little bit. Some of them get really lucky just because the order of wins and losses makes a big difference in how we trade over 100 trades. But by and large, over the long haul, you will lose a lot more money by trading, by moving, getting into a position, increasing your size from 1% to 3%, and your drawdowns get much more severe. Look, even on something that's barely a losing system or a break even, barely a break even system, 50% win rate on 0.93 R factor. Look at some of the drawdowns. They're way down here. You're talking about a 40% drawdown. All because what? You're risking 3%. And that's going to tilt you. And when it tilts you, it is going to compromise your judgment. So, the reason I'm making this video is to appeal to traders who simply think that they can get away with increasing size and scaling out, and that the occasional big loss is not going to reverse weeks of trading. As a trader, you cannot be somebody who plays and moves your stop, ignores your size, and who constantly adds risk and think that that is going to be a long-term method for success. It simply will not work. And that is what the Monte Carlo demonstrates. So I'm passionate about this because I have seen so many traders with tremendous edge blow up, all because they cannot manage, first, their psychology, which includes risk. And risk is placing a stop, honoring your stop, honoring your account sizing rules for your strategy, sticking with it, and losing graciously, all while you have trading edge. And that is the only way to stay in this game long term and not blow up your account, because there are way too many people blowing up accounts in futures because they do not understand how sizing works. So anyway, risk well, manage your psychology, then before you put on any trade, know where you're wrong, honor your stop, don't move it, don't size up. If anything, you want to get in again, that's fine. Get in again, take another trade, and live to trade another day, another week. Don't blow up your account on a single trade. Take care. Trade well. Bye-bye.